Thank you, Nils, for that thorough overview. Clear directional recommendations. We will dig a bit down into the details and cover some of the aspects of the shipping markets now with a great panel with industry leaders. I'll start off with Moritz Fuhrmann, CFO and co-CEO of MPCC Container Lines, global player in the container space. Next to him is Boye Petersen, CCO of Pangaea, soon to be CEO of that company, which is a dry bulk logistic and transportation provider. And at the far right, Jonathan Fancher, CCO of Petredec Group, a leading player in the LPG space. Myself, I'm heading the Rikard Vabo, heading the investment banking division in Fearnley Securities. We'll try to cover 4 areas today. Start off with macro, geopolitical environment and tariffs, market dynamics and trade patterns on demand side, the second one. The third, fleet and asset strategy, so more on the supply side. And last, not at least, the financial strategy, capital structure and Japan financing. So let's start off with a bit overall macro perspectives here. Nils said it was a geopolitical minefield out there. New tariffs are introduced, new port fees, wars ongoing, new regulations. You know, last week we saw net zero was postponed by a year, and that's up in the air. But the question, you know, how do today's geopolitical developments reshape global shipping dynamics? And would you have any real case alternatives how that impacts your company and how it operates? I'll start with you, Moritz.
Yeah, thank you very much, Rikard, and good afternoon. It has certainly become much more difficult to maneuver the geopolitical landscape that we see today. From our perspective, we have been, quite fortunate to have been able to steer away from at least the most recent implications that we have seen when it comes to USTR and the new port fee that has been introduced in China. From an operational point of view, it gotten more complicated for us as a company, but generally speaking, or fundamentally speaking, the impact has been so far very low. We are, in the container space, we're obviously benefiting hugely from what is still happening in around the Suez Canal. So the big liner companies are still rerouting the vessels around the Cape of Good Hope. There is a ceasefire agreement in place now. Remains to be seen whether that is really turning into reality in the next couple of weeks. And then it depends on the liner companies as to when they will start using the Suez Canal again, and that will certainly have an impact on the container market and then eventually also on us as tonnage providers. In terms of real-life examples and strategy, I think, maybe a bit dissimilar to my co-panelist, our business model is pretty simple. We buy and we sell steel, so there's not much around strategy. Strategy-wise, what are we trying to achieve? We strongly believe that scale matters, so we want to grow the platform that we have today in terms of assets to be more relevant and commercially more relevant to our customers, the liner companies. And that obviously means investing both in the existing assets, but also buying new assets. And our customers, they have become certainly more demanding when it comes to sustainability. We ourselves, we also believe in, becoming more sustainable. So then coming back to, buying and selling steel, strategy-wise, the focus is certainly on, making sure that your assets are being future-proof. So we have been investing heavily in retrofitting the fleet, buying modern second-hand ships, and then also most recently being in particular quite active on the new building side, making sure that our vessel portfolio is meeting future demands by our customers, the liner companies.
Thanks for that. It's a very broad question, so I'll dig a bit more into the details here before sending that question over to the co-panelists there. initial tariffs were introduced in April, and that has had a impact on the shipping market. U.S.-China talks is postponed or is expected to be in place November 10th. I've seen figures that these potential tariffs could impact 400, 500 million metric tons in the commodity space. It will impact containers, car carriers, and LPG. And with regard to the last commodity, how are you positioning your company in this trade war environment, Jonathan?
Good afternoon. A little-known fact, I think, even now, is that prior to April, prior to the initial wave of tariffs, LPG was the number 2 in U.S. dollar valued product imported into China from the United States. So a minefield is a good description. Obviously, from there was a bigger correction to immediately take place because a lot of that demand is price elastic. Propane feeds propylene, polypropylene, and then plastics. So it's not that version of demand that LPG is also very well known for in the residential use. So price correction was severe. Everyone certainly felt it. We were not an exception to that. I think one thing that maybe differentiates us a little bit is our business model within the space. We're not uniquely a shipping company. We're really more of an LPG value chain company at the end of the day, all the way from where we load products, largely in the United States at the moment, to where logistically optimize it on the water and then discharge it into our own terminals in developing parts of the world, largely in the global south and the Indian Ocean basin, and then wholesale distribute within those countries. So, our ability to kind of move along that value chain and redistribute and reallocate resources within that value chain and not just being subject to the shipping element is kind of, I think, insulated us and allowed us to do a bit more in the space.
Thank you. A bit more on the port fees. U.S. introduced last week. We see counter measurements from China that will impact U.S.-built and U.S.-owned companies. U.S. is involved in 12% on the seaborne trade. China, over 30%, the biggest shipping market. And this will obviously impact the fleet and utilization, will cause disruptions and inefficiencies. But how will this impact your sector, and how do you position yourselves the next couple of months? I see on Bloomberg it stated that both the company to Moritz and Mats have over 25% U.S. ownership. I will not confirm it. I just read it. But Mats, what would your response be?
Yeah, it's the latest curveball that's been thrown at us. Of course, the Chinese fees and something that has kept certainly myself very busy the last week. I think for looking at Pangaea in isolation, I don't think it will have any sort of really long-term impacts for our business. We are probably have 75-80% of our business in the Atlantic. China for us has historically been a place for dry dockings. We don't have any contracts, commitments in and out of China. But of course, in the short term, there might be some disruption from some ships we have going in that direction. But we have almost half of our fleet is Chinese built. They are exempted from the fees. So I think after sort of the initial shocks that I think the industry experienced in the short term, I think there will be a natural readjustment or rebalancing of the fleet and location of where they trade, similar to what we saw with the USTR in the beginning of the year. So the Chinese influence over dry bulk shipping is much larger than the American influence over as you mentioned. So I think it's maybe still too early to see if there will be a sort of a longer term imbalance. But I think that's my own personal opinion that you probably could see that in the meantime of some fleet adjustment. And of course, and when it comes to shareholding, it's essentially out of our control. We can't control who buys and sells the shares, but we are a U.S. company. 8 out of 9 board members are US. So, this is, but again, it's not something that I envision will have a long-term negative impact on our business.
Moritz, you shook your head.
Yeah. Yeah, I think Bloomberg needs to work on the data quality because we are nowhere near 25% American shareholding. We are far below that. Our board consists of German, Danish, and Norwegian nationals. So it's the just introduced China port fees is not affecting us at all. And on the other side of the ocean in the US, majority, I mean, first of all, the fees are being borne by our customers, the liner companies, but obviously we're trying to be helpful, providing the right assets. So most of our assets are below 4,000 TEU, which is exempted, and the vessels that are above 4,000 TEU are non-Chinese built. So we are not at all affected by the most recent turmoils created between US and China.
Well, enough now for tariffs and regulations. Back to the fundamentals on the demand side. Niels presented a relatively positive outlook for tankers and dry bulk, maybe a bit more muted on gas and containers. But Mats, within the dry bulk space, do you agree with him? And what's driving demand the next 12, 24 months?
Yeah, it's hard to argue with numbers, right? But I think we share the view. We are sort of cautiously optimistic, I would say. Not necessarily expecting any huge negative corrections, but it is a very volatile market and almost impossible to forecast. So I think demand over time will always sort of trend upwards. There would be fluctuations year to year, quarter to quarter. That's not unusual for the business. I think when I look at our risk and sort of commercial risk with the market, there is still a lot of disruption that are driving the demand, ton-mile increases that maybe could go away over time. So we simply are, cautiously optimistic, but that's probably what I'd say every time you ask me, right? And we want to grow, and we want to also add some ships, but nothing crazy. But we do share the side that the long-term view is probably tending towards the positive.
So a question to Jonathan. Given fee structure and tariffs, how do you view the outlook for the LPG space? And are you seeing any new LPG trades emerging here and new LPG takers? Are we becoming less dependent on China?
LPG, as has been mentioned earlier, if you make it cheap enough on a relative basis, it tends to find homes, it tends to find new homes. It's a multi-use product with various applications. But there's no hiding from the fact that the Chinese demand needs to come back. The stats that were presented earlier on the order book, the export capacity growth in the United States, and then coincidentally an order book that matches up with the nameplate export capacity out of the United States as it always does. We are quite constructive on the market for the next 12 to 18 months. That order book doesn't really come into play until late 26 onwards. There's new export capacity coming at the end of next year. There's sufficient production right now to satisfy that new export capacity that's coming. But there's also no hiding from the fact that come 27 and 28, there is going to be a bit more sober times in the space. There's just no way around it. PDH capacity, import capacity, mainly in China, in 2017 and 18 was what took in the order book and the export capacity growth that took place during that time. We're having a hard time seeing from 28 onwards what takes this new export capacity out of the United States. And there is a decent argument to be made that export capacity doesn't necessarily equal exports when it comes to that period of time, largely because far too rarely does the question about production in the United States get caveated with, well, what's the price of crude? LPG is a byproduct of other oil and gas exploration in the United States. You need crude growth, crude production growth, and other associated gas exploration growth to be there for that to take place. And crude at $40 or crude at $80 leads you to a very different answer to that question.
Moritz, how is Chinese demand impacting your business?
I mean, containers is not really subject to Chinese demand. I mean, obviously, thanks to the globalization and China being the workbench of the world, the fact that China is producing a lot of containerized cargo has been helping to boost ton-mile demand substantially. So the demand is primarily driven by the maturing economies in Europe and US. And there's obviously a strong correlation between GDP growth and container demand. That has been a bit sluggish, and also looking at the forecasts, I mean, you're looking at below 1% demand forecast, at least for the main lane trades, which is essentially Shanghai, Singapore to Long Beach and Rotterdam, representing the demand of the maturing economies. Luckily, for us in the feeder segment, and being primarily focused on the intra-regional trades, the emerging economies are growing much stronger than the maturing economies. So that is obviously helping boosting feeder demand. So the forecast for the next 2 to 3 years suggests between 3 up to 4.5% demand growth in the specific sub-segment that we are operating in. And if you combine that demand outlook with the order book that we have also seen in the presentation before, our view is actually quite constructive on the container space, at least in the feeder. So luckily, to answer your question, we're not demand-wise, we're not super dependent on China. Yes, China is producing a lot. Thanks to the COVID disruptions, you have seen a lot of producing companies trying to steer away a bit from China to diversify the supply chain. But that means not going back to the consumer countries. That means going into countries like Vietnam, Indonesia, Philippines, etc., which again keeps the ton-mile demand the same, and actually helps from a feeder perspective, because those countries are being served by feeder vessels and bringing the cargo into Singapore and Shanghai, from which it will be transported to Long Beach and Rotterdam.
Thank you. Jonathan, the title of one of the slides was LPG strong volume outlook, but order book curbs the enthusiasm. There's a big order book on VLGCs and MGCs, 27% on my figures. Will that order book exceed demand and impact the market as you see it?
I mean, the lag, I would say, that seems to exist at the moment between the order book arriving, a path to production keeping up in the United States to, I mean, it's almost 40%. I mean, production has been the savior for LPG thus far. But again, referencing what I mentioned earlier on the price of crude, what is crude going to do between now and then to stimulate that additional production in the United States to satisfy that new nameplate export capacity that is coming? I've mentioned it before. We're historically terrible crude traders, so I'm not going to get on the record with that today. But one needs to have a view on crude production in the United States to reasonably forecast what's going to happen there. And then something needs to happen on the demand side. There's no new PDH capacity happening in China. So this new demand sink, this demand pull. From the residential perspective, we're extremely optimistic there, especially in kind of some of the developing parts of the world, sub-Saharan Africa. These countries that haven't gone through this industrial revolution still don't have access to clean cooking. 1/7 of the world's population lacks access to clean cooking. Building out the infrastructure for import facilities in these parts of the world is a big push for us at the moment, and hopefully with others. So you will see natural growth in the space from a demand perspective, but something needs to, 40% growth. That's why I keep kind of pointing back to the conversation on whether or not exports end up equaling export capacity. That being said, those who have a strong balance sheet, resources to put to work in that 27, 28 is going to create probably some incredible opportunities to grow fleets. That order book is large, but it's also extremely expensive. I think of all the ships that are delivering from 27 onwards, they have an average weighted average price of about $115 million. So you're in the low to mid 40s break even. There, the average chartered in rates across the fleet are extremely high as well. So those with dry powder resources to deploy could really be in an interesting position to grow as and when the time comes.
Okay. We looked at some graphs on new building prices. So if you are afraid of heights, you should maybe stay away according to historical levels. But we have seen earlier this week there were a company in Oslo raising $110 million for 2 VLCCs at $118 million. We're talking here about cash break-even throughout the lifetime on 11% unlevered return of $52,000, $53,000 a day, which might be a bit high historically. But we can also look at new building prices. There's been cost inflation everywhere. If you inflation adjust new building prices, for example, for a VLCC, it would cost $225 million in 2008. So from that perspective, it seems more reasonable. But the capital market at least believes in positive returns on today's new building prices. A question to the panel here: are new building prices high at the moment? Define it as you want. Moritz, I'll start with you.
Should I? Yeah. I think the simple answer is yes. Depending a bit on your company and fleet portfolio and composition, and the question, how much are you forced to look into fleet renewal at any given point or this point in time? So only speaking for ourselves, we are pretty active on the new building side. In fact, because we want and we need to renew the fleet. I think the good thing in containers right now, and maybe having a bit of a competitive edge relative to all the other asset classes, is that in containers you are in a position now to get some time charter coverage, which obviously helps to de-risk the investment or to mitigate the relatively high entry price. So there's obviously other segments where it's much more difficult to get maybe the needed visibility to structure a compelling investment case. And that's also why we're only looking at new builds in combination with at least a certain time charter coverage. There's also other peoples out there right now going for speculative orders in the feeder space because they buy into the supply side story. But at least us being stock listed and also having certain demands from our investors, we're only looking into combination and time charters and the alignment with the de-risking that comes along with the time charter.
I spoke with some Japanese shipyards, and we're talking now about 2029 deliveries. Given the visibility on the supply side, how is that impacting your considerations about the fleet and your growth strategy going forward, Mats?
Yeah, it's thank you for Moritz for taking the first question, because it's a little uncomfortable question to ask in front of so many shipyards and trading houses, and I don't want to offend our hosts here, but I think I think it was 2028 yesterday, and now it's 2029, so things are moving, right? It's no, but it I think the diplomatic answer is, from my discussions this week here with trading houses and shipyards, they're very comfortable in their position where they are, and I think it's undisputed that when you're looking at historical prices, it's pretty high, at least for the last sort of 15 years. You're looking at very high numbers. We have historically really only built ships for new buildings when we have needs in our ice class niche. We have otherwise grown the fleet through second-hand acquisitions, and those prices are also high, but I can make a little bit more sense of that. You get an asset right away that you can start trading. I think we struggle with both the prices and the lead time now with any shipyard. So it's I think on the dry side, in the segments below Cape, it is there's a dislocation there, and I don't think that the yards are motivated to do anything. They're very happy where they are, and the spot market seems to not really want to meet it, those prices. So I think for us, even though we also, of course, have fleet renewal plans, they will likely not involve new buildings from this position.
I'm speaking only from the LPG perspective here, but yeah, I would say overwhelmingly yes. You know, you don't have to go back that far. 5 years ago, where VLGCs were being ordered, almost exactly 5 years ago, for $75 million, and I think that they peaked out at 127 and some change. Given where the order book is right now, and again, understand why it is where it is because of other sectors, and it does look like other sectors are, you know, there are some underbuilt places that, you know, that are going to eventually come into the market for fleet renovation. But in the LPG space, they're already coming off. I mean, I think that, you know, for those that would have the relationships, you know, whether it's Korea or China, not as in tune to the new building market here in Japan with VLGCs, but you know, you're already starting to see those prices come off of those highs to the tune of 10 to 15%, I would say.
Guys representing containers, dry bulk and LPG, are you looking for opportunities outside your core sectors at the moment? We see huge volatility and discrepancy in prices, etc. You know, does that encourage you to look outside your core sectors? Open question.
I can start with that. The short answer is no. We see tremendous growth opportunity within the dry bulk in this sub-Cape segments. We see great opportunities on our logistics, in our logistics offering, in our terminals. So we have no shortage of opportunities that we want to pursue, even with everything that's going on around us. It's in our conversations when I sit down and talk to our customers, you know, it's a pretty resilient business, and everyone has been, you know, from where we were early in the year to where we are now. I think everyone is just getting on with things, and we see I think actually decent flows and decent growth in our sort of very specific niche markets. We're very excited about that. So we have no we don't feel some sort of a need or pressure to try and reinvent ourselves going outside our comfort zone.
We're actively beginning the process of entering into the LNG space, and so yes, absolutely. You know, we view that space to be going into a point in the cycle where barriers to entry are going to be, you know, as low as they have been in any recent memory, and as low as they're likely to be, you know, for years to come. So using that opportunity, you know, we feel confident in our ability to analyze the space. You can draw a lot of parallels between LPG, how that market is going to evolve, and so our ability to kind of analyze that gives us comfort. The evolution of Petredec, for those that are familiar with the company, it was a slow evolution. You know, small trading and logistics company who eventually entered into the shipping space and then became a ship owner in its own right. The path will likely be very similar to that, but it's something that we're very committed to. So I'm going to use this as a cheap advertisement. Anybody who wants to come build an LNG desk, just give us a shout. So.
But what are the synergies between LNG and LPG? You know,
synergies less so, but the same story that I was talking about earlier with respect to an order book, a huge export capacity growth out of the United States and the Middle East, relatively flat import demand. That lag in order book export capacity and demand picking up, we think is going to finally create a spot market in the space that people have been kind of predicting for years, but we think that given the order book export capacity and the mismatch in timing with respect to demand catching up is going to create that opportunity for new entrants.
Okay. Interesting. On the new building side, Moritz, last week you announced the two 1,600 TEUs for $66 million. You stated vessels futures are state-of-the-art fuel-efficient design for the European trade, but we saw no methanol or dual fuel or ammonia or alternative fuels. What are you thinking about, on the fuel side? But please don't go into too much detail because this is getting complex.
And I can't. I'm not a technician, so I don't want to dare to pretend to be an expert. And that sentence obviously is the typical capital market narrative. But those vessels are in fact relative to the vessels on the water once delivered the most efficient vessels. What's our view on propulsion technology? Obviously, we don't have to answer what is the future. We would like to have exposure to all the alternatives that are out there. We have methanol dual fuel vessels on the water, one to come. We're looking at something in the LNG space, and we're also spending time, although maybe a bit premature, on the ammonia side of things. I think a lot of the propulsion technology is being determined, or should have been determined by the IMO Net Zero, which last week has been postponed. We think eventually there will be new regulation coming out of the IMO. We don't know yet in what shape or form, but it will certainly define what advantage certain propulsion technologies have in the future. Why did we order conventional? Because simply that's the demand by our customers, the liner companies, because also on their side they don't know what the future is. Interestingly, what has been very en vogue in terms of sustainability the last, let's call it 10 years, has been changed quite drastically ever since Mr. Trump has entered the Oval Office again. So you can see a clear change, in pattern and behavior by some of the people. Obviously, not only in shipping, it's industry wide. So just an interesting fact, the two methanol dual fuel vessels we have on the water, they are trading on 5% methanol, which is the minimum content you need to have to keep the engines running. Our charterer, they have an offtake agreement with Equinor for, keeping the vessels running on 100%. But they're simply saying our customers are not paying for the fuel, which obviously is more expensive than low sulfur fuel or heavy fuel oil. So it's, I think the answer is, we do what it's best for our customers, and as long as there's no clear path to what the right technology is going forward, it's very hard to go all in, because obviously there's also a capital commitment you have to make beyond what the conventional vessel will cost.
Clear answer, thank you. A bit into the last theme of this panel discussion, the financial strategy, and what you're thinking about capital structure. We are seeing very aggressive bank lending across the globe towards shipping. The high yield bond market is record low margins. Last week we saw CMB Tech, Navios, Kinetics, everyone is out trying to tap the bond market. And we are seeing new companies entering the market probably within the next 1 to 2 months on the equity side. So that will be interesting. But Japan financing is high on the agenda, offering very competitive terms. 22% of the top 40 financial banks are of Japan, which says something about their institutional involvement in this industry. So I'll ask a few questions on this theme. What role does Japan financing play in your company's capital structure? Moritz?
Yeah, I can start. Looking at our order book, which is growing, and since shipping is a very capital-intensive industry, the debt capital will play a certain role in the capital structure. And we're actively expanding our banking universe, and in particular in Japan, which has a big strategic importance for us. Not only because there's capital available, also from the point of view that there's trading houses, there's operators, there's shipyards, as well as Japan being the largest maritime economy globally. There's obviously a profound understanding about the cyclicality of the market. So right now we're spending a lot of time both on the debt side, where we've luckily been able to conclude the first transaction this year, also with companies being present here today, and as well on the equity side, which obviously will take time to get people comfortable co-investing on the equity side in container vessels. So on both parts, the Japanese market plays a very important role for us as a company. In particular, and coming back to my comment that the Japanese market understands shipping, both in terms of what can happen in terms of negative volatility, and we heard before there is certainly negative volatility on the horizon in the short term, but shipping is not a 5-year game. Shipping is a 25, 30-year play, and having people on board both on the debt and the equity side, understanding the longevity of the market, it's certainly very helpful.
So Mats, how are you incorporating Japan leasing, JOLCO structures, etc., into your structure? Is it strategical approach or a more opportunistic alternative to traditional bank lending?
I think Japanese financing in general is an absolute core for our company. More than half of our facilities are with Japanese financed institutions, and JOLCO is one aspect of it. And I see the evolution with our company from when we made our first facility out here in 2016, so it's not that long ago. But just to echo what Moritz said, is that there's a really deep understanding of how the markets work. There's a long-term commitment to ship finance that you might not find in other countries, and in sort of maybe in the Western banks that tend to sort of jump in and out, typically at the wrong times. And I think there's just a appreciation for our business in terms of having a long-term view and a little bit more industrial focus. It's not just asset plays and buying and selling ships all the time. I think that matches very well with the sort of the culture and the attitude of many of the Japanese banks. So we have found this to be an incredibly interesting and welcoming environment and market for us, and just from our meetings this week, we are very excited about the future and what we can continue to do out here and even build from where we are today.
Jonathan, why is Japanese financing attractive? Is it pricing, long-term relationship, leverage? What makes it interesting for you?
Certainly the pricing and the leverage, but I would focus primarily on both the relationship and just the reliability of it and its ability to not impact business. We had some Chinese leasing. We've gone out of that, but you've got business partners in a safe, stable environment and can build a business and look forward long term without having any geopolitical issues to really enter into the space. We've been doing business in Japan for decades, like most of the room, but and always appreciated the relationship side of the business, but even more so on the banking side. 3 years ago, we didn't have any exposure to Japanese financing. Our CFO John's done an amazing job in developing those relationships over the last few years, and it's gone from now pushing 10% of the overall portfolio, and that's something that we absolutely have the intention to continue to grow.
Good. Last question for me, and if there's any questions in the audience, please feel free. But Jonathan, you have already answered this question, so this is for Mats and Moritz. If you had $10 million you could invest in shipping, but it needs to be outside your core sectors, where would you invest your money? And just to repeat, Jonathan would obviously put that in LNG, right?
Not in LNG shipping yet. Not yet.
I think shipping, generally speaking, is a very simple business. You have demand, supply, and if you look back historically, the last 200, 250 years, with an exception of maybe a handful of years, demand has always been growing, and it will also in the future. So that isn't the problem. The problem is that shipping does a terrible job in overbuilding the industry, irrespective of the subsegment. So I would be, to answer the question, I would always be solving for the order book, and then the obvious answer is container feeders, but I'm not allowed to say that. So, LPG is north of 30%, LNG is, 40%, tankers is north of 20%, so I would be solving for dry, because dry shipping has an order book of, I think, across the board of 10.5%. There might be some interesting subsegments in the order book in dry where you have an even lower order book. Question is a bit around China and the demand, but I wouldn't be too concerned about that personally. So I would be investing in dry.
We don't need to hear all the rationale from you, Mats. What sector?
That was great. Thank you.
Yeah.
I'm going to cheat a little bit, and I'm going to say the closest thing to what we do at Pangaea. So I guess Capesize, maybe. Was that allowed? Could I say Capesize?
Okay.
All right.
But again, any questions in the audience? We have been able to cover quite a lot of areas with this panel today, so thank you very much for the panel. Thank you.